Welcome to the Stay the Markets podcast. I'm Paul Rodriguez of thinktrading.com.
I'm Tim Price of pricevaluepartners.com.
And our very special guest is Alasdair Macleod.
Alasdair Macleod, welcome to the show.
That's my pleasure. Thank you for having me.
So for those people who won't know you, and I suspect most of our listeners will, could you give us a quick a potted CV, please?
Yeah, I've been around for a long time, I'm sorry to say. I became a stockbroker in 1970. I've been a broker, I've been an asset manager, I've been a banker. And I was, for something like 12 years, 14 years, I was head of research at Gold Money. I relinquished that position recently to set up my own Substack, which I did at the beginning of last year. I spend most of my waking moments doing that, thinking about it with the objective to educate as wide a population as possible about money, credit, economics, markets, and why you should now be actually preserving wealth rather than trying to accumulate wealth, because the whole system is looking very, very terminal. So that's basically... I started, if you like, at the beginning of, just before the end of the Bretton Woods system. And here we are, I think, at the end of the fiat currency system. So this should make for an interesting podcast.
You mentioned education. Do you think it's a problem that the educational system appears to do nothing in terms of educating people about money and maybe investments, but first money itself?
Well, it's worse than that. It misleads people. The idea that people actually know about money has always been completely wrong. They don't. Very few people really understand it. Even economists. I've been involved with a debate with Austrian economists about the creation of credit. They don't understand credit, which I know sounds bizarre, because their USP is they understand these things. Well, they don't. There's a big hurdle to overcome in terms of educating people about money and credit. So, the answer to your question is that I think everybody's being misled, and they're being misled by people who are meant to be experts who don't understand it. So, it's quite a thing to do.
So what should we know about credit that, or what isn't taught about credit that people should know? Well,
basically, you've got two means by which you can purchase and sell things. One is final settlement. And final settlement is always payment in physical gold or silver. That goes back to Roman law, which started with the 12 tables going back 448 BC. And various jurors ruled on this and how credit works and all the rest of it relative to gold or silver or metallic money, if you like. It was all incorporated in Justinian's Pandects. And that is the basis of everyone's common law, because coming out of the Roman Empire, both East and West, were all the nations that have colonized the world. And separately, China has arrived at the same sort of conclusions over the millennia that we have. So that's money. Now, the rest of it is credit. Credit is not final settlement. Credit is an obligation to settle. And that obligation to settle is always in final settlement, what they call corporeal money, which is physical money with no counterparty risk. There was basis, if you like, of gold standards. And I think the highest value, the best system that evolved over the millennia was really the UK in the 19th century, when the sovereign came into being. And we went on to, the pound went on to a gold standard, fully exchangeable. You could exchange the Bank of England's pounds into sovereigns. Between about 1822 and the outbreak of the First World War.
There was no inflation.
There was no inflation, yeah. And this is the other thing. Understanding how credit creates inflation is another thing. Because if credit is deployed in the form of, let's say, capital to increase production, it's not inflationary. If, however, it is deployed to increase consumption in lieu of savings, then it is inflationary. And if it is deployed to puff up asset prices, which actually is what's going on today, then that inflates asset prices. So, but for every credit, there is a debt on the other side. Now, we all recognize there's a debt bubble, but do we recognize we're in a credit bubble? I think very few of the people punting in, the momentum stocks in the market actually understand that it is a credit bubble. And, you've got to point out to them, debt is the other side of credit. You can see the debt. It's obvious. This is the biggest debt cum credit bubble in history by miles, far bigger than 1928 to 29, roaring 20s, and what happened subsequently. This is far, far bigger.
And isn't the problem with the debt bubble that the central banks simply cannot afford for deflation to exist? So we will get inflation, and as far as I see it, that ultimately ends in either hyperinflation or currency collapse or both.
Yeah, I think what you're referring to is credit substitution. There is no doubt that as the credit bubble pops, then financial asset values are going to go down. You will find also the risk of holding credit rises, which basically means that interest rates or bond yields along the yield curve will rise. And under those circumstances, the central banks tasked with being the lenders of last resort will try and replace contracting private sector credit, commercial bank credit, etc., with fresh currency both in the form of notes and also reserves on its balance sheet. So, you're right. And it's that will collapse the currencies because we cannot afford, if you like, to allow our economies to go into what they call recession. We used to call it a slump. We're already doing that, incidentally. If you take government deficits out of GDP, remove that from GDP, and over the last 2 or 3 years, you can see that we're already in a slump. And you go up and down the country, go into the high streets, see what's going on there, go and talk to people, see what's going on with them. And things are extremely difficult. But, this doesn't show in government statistics as much as it should. So we're already got the conditions, if you like, that are creating this existential crisis, the end of the fiat currency system.
And presumably it's gold that's primarily signaling there's a fire raging.
Yes. I mean, the way to look at it actually is not gold is in a bull market. Gold is
all currencies are in a bear market. But
all currencies in a bear market. Currencies are going down. I mean, the way you've got to look at it is you're not buying gold, you're getting the hell out of credit. Because currencies are credit. And incidentally, modern economists don't actually recognize that currencies are credit. They're not well versed in the difference between money and credit.
So just to make sure that I understand your thesis here. So you're saying going back to the Roman times, basically everything that isn't gold is credit when it comes to money. So then the only thing that is money is gold.
Well, we've evolved to gold. When the 12 tables came out, the Romans produced the first coin.
Sorry, Alasdair. Could I just stop you there? You mentioned that I was going to come back to the 12 tables, but I don't know what the 12 tables are. Could you just tell us what that is before we go?
Well, 1 12 is 12, 2 12 is 24, Paul. Didn't you go to school?
Oh, you just meant maths. I thought this was like tables as in... No.
No, the question you asked him is absolutely right. It's the right question to ask. The first attempt by the Romans to bring in law, if you like, to regulate how people behave with each other and with the authorities of the day, were the 12 tables. Or you could interpret it as the 12 tablets, which, of course, was really what tables meant in that sense. And this governed all sorts of things. The relationship between the leader of a house and women and the slaves and all the rest of it. Now, a lot of this doesn't apply today. A lot of this we've evolved away. But they did determine what final settlement was. And we're talking about it at a time when very few people could read or write. So there were all sorts of procedures to ensure that you had final settlement, and also to establish what wealth individuals had, and possession and property rights and all the rest of it. It all stemmed from that. At the same time, they produced the first Roman coin, which was called the ice, spelled AES. And the ice was about £1 of bronze. Gold and silver came in later, in fact. But we evolved into a situation where gold and silver became the preferred, higher value coins. And that, of course, persisted the whole way through. And it persisted all the way through to relatively recently. I mean, we got sovereigns. We had coins made out of silver and coins made out of copper, which was the third element. I mean, if you like, copper was the pure form of bronze, or the dominant form of bronze, which the ice was made out of. So that was the origin of it. And over the next 1,000 years, basically from about 450 BC all the way up to the 6th century, when Justinian's Pandects came out, you had Roman jurors ruling on things like settlement. I mean, all sorts of aspects of Rome, just developing, if you like, from the 12 tables, all these, sort of considerations, what was criminal law, civil law, all this sort of stuff really came out from these jurors. The principal jurors who determined the role of credit in an economy and how it should be treated were a juror called Ulpian and a juror called Paulus. And Ulpian and Paulus lived around about the 1st and 2nd centuries AD. Or more likely the end of the 2nd century AD. So we're looking at around about 200 AD. So these guys, and particularly Ulpian and Paulus, as opposed to Gaius, who was another one who made all sorts of rulings, they determined that you could transfer a debt without having to get the agreement of the debtor. Now, this is terribly important because if you can buy and sell debts, then you've got the basis for value and basically of wealth. And this is, I mean, without the ruling of those two jurors, you wouldn't really be able to buy or sell corporate bonds, government bonds, whatever. I mean, it all stems from Roman law. And Roman law is the basis of our common law. Now, just to add a little bit of interest on this, when the Romans left Britain, this was before Justinian's Pandects. Pandects being in about the early 6th century, and the Romans left here in the 5th century. So we had in our common law the findings of Gaius. Now, Gaius did not reckon that you could transfer credit, debts, if you like, without the agreement of the debtor. You had to get the agreement of the debtor. So we had in our common law, until the merging of common law and equity, which was in about 1870, 1875, we still had this problem that there were two sort of rulings on the whole thing. But anyway, that went when the courts of the Exchequer merged with common law back in, I think it was 1875. So now absolutely everything can be transferred without the agreement of the debtor. If you've been in the unfortunate position of reneging or unable to pay your credit card debt and you become a bad debt, then you will find that debt gets sold from the card issuer to a collection agency. they will buy that debt at a fraction of face value, and then they will try and recover what they can from you. It's all this can be transferred without your agreement as a debtor, and it's very, very important. And it is the entire basis of markets and our wealth. So this is very important. People do not understand this. You've got to go back to the basics of common law to fully appreciate the difference between real money, final settlement, corporeal money, and incorporeal money, which has no physical presence whatsoever and is merely an obligation to settle in the future.
So knowing that, how does that just change the lens with which we look at the market and the risks that we see going forward? Because when you were saying that there's the most amount of credit creation right now compared to before, isn't that always the case? Because at any stage, if you were to go back 20 years, wouldn't we have been in exactly the same position and back again? Aren't we always just on this upward trajectory of always being at the highest level ever, and with little dips in between, but generally on this long-term path? And why does it matter now as opposed to any time in the past?
Well, the answer to that one, Paul, is that we all work on credit. We never, even under a gold standard, you wouldn't dream of paying your workmen or whatever in gold sovereigns. You would always pay with a bank transfer of some sort, a check or cash. In other words, a gold substitute, which is really what a Bank of England note is. So you would never really use gold. You always use credit. In any healthy economy, there will be a lot of credit around. But the problem becomes when there is too much credit, the debt, if you like, is unsustainable, and therefore the situation goes into collapse. If you have credit which is expanded to finance production, then basically you have an extremely healthy economy. Where it goes in to finance consumption, then you're driving up prices. And if you're not driving up prices, then what happens is that your gold reserves, the central bank's gold reserves, decline. And this was the situation that we had from about 1947, when the US Treasury's gold reserves were in the order of 22,000 tons. We're looking at something like 60% of above ground gold stocks at the time. By the time we got to 1971, it was down to just over 9,000 tons. The reason that there was a run on, if you like, on the US gold reserves is because prices were suppressed by the link between the dollar and gold, and people were taking out gold. They were exchanging those dollars back for gold because they realized that there was this tension, if you like, between the two. As long as you could exchange it for gold, then, of course, what would you do? You would exchange your dollars for gold. And that's what nations were doing because, of course, you and I couldn't do it. We were banned from doing it. So it's a question of scale. We need credit, yes. It is the basis, if you like, of post-feudal economies, very much so. But it's when the situation gets extreme and credit is pushed into the wrong direction, like government printing it to finance their excessive spending, that you end up with credit bubbles. And of course, we've got huge great credit bubbles in government. You've got a lot of what we would call zombie loans, if you like, zombie companies in the private sector as well. Everybody's up to their neck in non-productive credit. And of course, the third way in which credit is used, which I referred to earlier, is to puff up asset prices. It's lovely while it lasts, but you're sitting on top of a volcano, and sooner or later you're going to get wiped out. If you could talk to the citizens of Pompeii in 70-odd AD.
To what extent do you think central banks will be able to survive the market environment to come?
Well, they won't. It's a short answer. I mean, this is
They won't be able to survive it.
Absolutely. They are the lenders of last resort. They will destroy their currencies. I mean, have a look at long bond yields. If you look at the yield on the long bond, I'm not talking the 10-year, which everybody looks at. Look at the long bond. Look at the long gilt.
The 30-year, you mean? Is it?
Yeah. Look at the long gilt. Look at the yield on that.
Yeah. US is 4.92% at the moment.
Yeah, absolutely. When that goes over 5%, I mean, just look at it's just been sort of knocking on that sort of level. The underlying trend, you're going to see that yield go through the roof. That's going to happen. I mean, I can't remember. I mean, I'm not sure. Were you around in the 1970s, Paul or Tim?
As a nipper, I was.
Yeah, me too.
Right, okay.
Tim was buying his first coins when at the age of 3 or 4.
I was hodling sovereigns even then.
Well done,
I was stacking.
You were stacking. Well, the point I was going to make is that we had a similar situation in the UK. I mean, the political and economic situation in 75, 76 led to a run on sterling, which led to the US basically supporting sterling and then sending the IMF to sort us out. So left-wing luminaries like Paul Foote and all the rest of it sort of threw their hands up in horror and resigned when cuts in public spending were forced on the British government by the IMF. And I remember the issuance of gilts at that time. There was a 15% coupon. There was a 15.5% coupon. There's a 15.25% coupon. 15.5 is in 98. I remember it well. And that was issued at a discount to par, too. So just imagine, that's roughly where we are today.
I saw an amazing statistic the other day that the Tony Blair administration is the only Labour administration in history that didn't end in a currency crisis. All the others have done.
Yeah, well...
it's almost as if there's a message in that somewhere.
I don't think there is much of a message in that, really. No, the point I'm trying to make is that when government spending gets excessive and the political situation is going the way we are now, incidentally, then you'll find that both foreigners and domestic institutions will refuse to buy their debt.
Is that UK centric, or do you mean US as well, or G7?
Well, okay, G7, because just look at those long bond yields in the US, the UK, Germany, which is the risk-free ECB or Eurozone government debt, and also look at the long JGB. I mean, that's soaring. I don't know. Get those charts up. You'll see they're terrifying. Well, they're breaking out on the upside.
Yeah, I can see the UK's not that 30 years definitely looking very, very worrying as to where it is.
It seems like Rachel from Accounts maybe shedding a few more tears before too long.
Tears before bedtime. I tell you what, she'll be shedding tears before her autumn statement. Now, this is actually a very serious point. We will have the crisis, the bond crisis, before she stands up in the autumn statement. Now think how that's going to affect things.
So a question I was going to ask prior to you saying that was what are the signs, because the system can operate in a way that is less than ideal for a very long period of time and nothing really happens, and then suddenly things start to move very quickly towards crisis. What I guess the bond yields are the first sign of this happening. Are there any other signs that you look at?
Well, I think that's the principal sign. The other thing I would say is that the relationship, the value relationship between bonds and equities has gone very far adrift. I mean, it really has. I run a chart whereby you take the yield on the long bond, index it back to 1985-ish, something like that. Index the S&P at back to the same date. Run the long bond yield inverted, and you will get a virtually perfect inverted correlation between the long bond yield and the S&P. Now, this is very important because when you get a divergence from that, then something is going to change. The big divergence we saw, or the big divergences that we've seen so far, the biggest since 1985 was the dot-com boom. That was the first one. And that was tripped by rising bond yields. The next one was the big financial crisis. Now, under those circumstances, what happened was that the bond yield was suppressed. And the final one, which is today, well, no, there was one also over COVID, when basically they suppressed the bond yield right down to something like 1.25%, something like that. The equity market was more worried, let us say, about the economic consequences of COVID shutdowns and so on. So that didn't really shoot up, if you like, as the bond yield declined. But now, today, the valuation disparity is the greatest since 1985, and I would argue the greatest in history. That is the extent of the equity bubble. And of course, on top of that, we have got the clearest sign of wild speculation, the sort of thing like tulipomania, South Sea bubble, the Mississippi bubble, and that is Bitcoin. The lovely concept, but what do you got? It's actually, that correlates very effectively with the Magnificent Seven. And they are momentum stocks. It's the same cohort who are long that of Bitcoin, basically. So, and it's a ramp, and it's full of bad people. That is going to collapse. That will collapse. It's like tulips without the bulbs in it. So,
to go back to your statement about central banks not surviving, to me that suggests that governments won't either.
Well, there's going to be huge political disruption of that. There's no doubt at all. Absolutely no doubt. I mean, just on a sort of relatively micro level, just look at the situation of Rachel from accounts. She can't cut public spending because her parliamentary party won't let her. She can't continue to raise taxes because we all step aside and say we're not paying that, which is already happening, incidentally. People aren't selling houses and creating capital gains. And we're probably not selling stocks. Not only that, we're not employing people because we don't want to pay the extra. And when it comes to minimum wage, we're not taking on students coming out of university to, just learn something, or even to act as waiters and waitresses in cafes and so on. We're not taking them on. I mean, the whole economy has actually shuddered to a halt.
So the system's going to implode under its own weight. Next step, CBDC, presumably.
No, that's. The problem with CBDCs is that it's rather like. It's just another form of fiat. It's rubbish, and not only that, but it takes so long to implement. We don't have time.
Isn't it rubbish with control? Just so for people who might not know the acronym, that's central bank digital currencies. But isn't it rubbish with government control, which is always better for them?
Well, yeah, but somebody's got to buy it, haven't they?
Well,
the answer is that the whole concept of credit is being blown apart by the excesses of debt on the other side of it.
I mean, part of my guess about how this might play out was that perhaps this is maybe engineered by design, or maybe it's just folly. Who knows? But either way,
problem, reaction, solution.
Suddenly, in the midst of a crisis, you might have the option to either have your bank account go to zero, or they offer you central bank digital currencies, and then you're kind of faced with no choice at all.
Yeah, but how do they distribute central bank digital currencies?
Well, I mean, electronically, that's easily possible. You could have one digital pound for every pound you have in your bank account.
They're going to rescue the banks. That's the first thing.
Well, of course, yeah.
I mean, the whole idea of central bank digital currencies was that you would have an account with the central bank, and it would be targeted. The central bank would say, we're waking up today and we think we ought to stimulate production of motor cars. Right, okay. We will issue digital currencies to the motor industry and its customers. That's the whole idea. It's all written down in the BIS paper on it.
Well, the history of central planning isn't exactly a gorgeous one.
No, you're dead right, because they've got no skin in the game. They don't know what they're doing, and they've got completely different terms of reference. So, it doesn't work.
So the system falls apart. Central banks are on the precipice. Governments are on the precipice. What then happens if you can speculate that far? What does the future environment look like once you've had these catastrophic failures of the system?
Well, terrible is a short answer. I mean, there's going to be.
Well, it sounds like blood on the streets.
Well, they're not going to be able to pay. I mean, what value will there be in welfare payments? Zero, effectively. You get collapse.
But this is something that Greenspan was honest enough to admit decades ago, that the US would never have struggled to supply welfare payments, but it couldn't guarantee the value of the money, couldn't guarantee the value of the currency.
Yeah, absolutely right. But we're now facing this reality. I mean, I really can't see there's any way out of it. I mean, eventually, what they should do is to curtail government's involvement in the economy, unwind, if you like, what Keynesian economists would regard as the progress over the last 100 years or 90 odd years since the 1930s. You've got to unwind that completely and have the private sector basically looking after itself without government, being responsible for its own actions. And you've got to tie the currency to final settlement, which, guess what, is gold.
Have we ever had a period in history where you think the system's been stable and likely to? I mean, recent history, like not going back hundreds of years, where you think things were working okay, and you wouldn't be in this crisis mode that you seem to be in at the moment.
I mean, we've had the problem in individual nations, yes, and currencies have been wiped out. I mean, obviously, places like Zimbabwe and so on. I mean, there've been. I think Rogoff and Reinhardt did a survey on this, and they reckon there was something like 63 or 64 fiat currency collapses that they recorded. I mean, there were others which they didn't record when I looked at the list. So this is not unusual. But what is unique this time is that because of complete government integration on the production of their currencies and currency relationships, without gold, I mean, gold, if you like, being the arbiter and everything, without that, governments are basically working together the whole time. And so this crisis is completely global. But this is the interesting point. It is global in the sense that we understand it, which is America, Europe, Japan, Britain, maybe Australia, a few guys like that. But there is the rest of the world, which the Asian hegemons are running. Russia, China, Shanghai Cooperation Organization, BRICS. Most of Africa, for example, which are going on to the Chinese settlement, CIPS settlement system, which basically is settlement in Chinese yuan. They are rapidly industrializing. I mean, we are the history now. We are killing ourselves off. And so this is a geopolitical issue. It's not the whole world that's going.
But China's got huge debts as well, doesn't it?
I'm sorry, what was that, Tim?
China's got huge debts as well, doesn't it?
Not nearly on the scale that we have. Not nearly on the scale. It's, I mean, yes. I mean, we come back to this point. You've got to have debt in an economy because it's the other side of credit. Nobody settles, or very rarely does anyone settle in physical gold or silver nowadays. That just doesn't happen. It never really did happen. The bulk of settlements have always been in credit. So, any economy that's successful is going to have a massive expansion of debt and credit. That's a fact of it. But it's when it's unstable, when it's bad, That is the key to understanding about the whole thing.
And how are we defining bad? How do you define bad then?
Bad debt basically is something which is non-productive and eventually cannot be repaid.
So we clearly want to earn, well, I think people should, if they haven't already started, they should consider seriously starting to accumulate gold. Presumably you wouldn't disagree with that.
Solutions.
Investment.
Yeah. What are the solutions?
Yeah. What I would say is just get the hell out of credit as much as you can.
In terms of other asset classes, are there any other investments that you think people should be looking at beyond bullion?
Well, nothing is actually safe in this credit collapse environment. What I would say, however, is that mining stocks, as some sort of vague gold or silver substitute, is something that you might consider. But how are you going to take your profits? You probably take your profits by getting back into credit. Yeah. So this is the problem. Everything is fiat. I mean, even we think of equities. Traditionally we think of equities as being, if you like, a hedge against inflation.
Yeah.
Well, equities actually are credit, because the management of a company in which you have shares have an obligation to distribute a dividend stream to you, or at least accumulate in your behalf in its books an income stream. So that is credit. Everything is credit.
What about quasi-monopoly type companies with little or no debt on their balance sheet?
Same thing. It's. They're going to get they will get undermined because the means of payment, currency, is going to lose its value. I mean, we just hope it doesn't lose all its value. But this is a situation where this, unless there is a volte-face in government approach to their relationship with the economy and all their intervention and welfare and all the rest of it, unless there's a change in that, these currencies are doomed.
So if you were in charge right now, would you be able to turn things around? Is it possible?
The answer is no. I mean, there's this new fashioned word or phrase, the Overton window. You got to wait. You got to wait until you get political support in order to do it, and you will only get the political support on the basis it's crisis first, solution second, not solution first to avoid the crisis. That doesn't work politically.
But if you had unlimited power right now and you were able to make changes, would you be able to do that? What would you do?
Well, let us assume that we have the collapse and all the rest of it. Then I would put the currency back onto a gold standard at the prevailing rate. I would cut. I mean, I would make Milei in Argentina seem like a moderate. I really would. I'd cut everything. I would do various other things, like I would insist that the Treasury changes its accounting system. So I would hypothecate revenue. I mean, basically, if you're going to pay taxes for roads, for example, then that's a road fund, and it stays there. It goes for roads only. You stop robbing Peter to pay Paul, which is the whole. Very convenient for the Treasury. It gives them an awful lot of power. Take that away. Take it away. That's what I would do, and I would do away with tariff barriers. I mean, that is another thing. I mean, if you want to look at something which is similar to 1929 to 1932, credit bubble plus Smoot-Hawley Tariff Act, we have credit bubble far larger and more sophisticated supply chains and logistics, which, when they collapse, are going to have a tremendous effect on everything. And we've got, Smoot-Hawley Mark II with, we don't know how it's settling out because Trump is capricious, to say the least. But you got that combination. What happened in 1929? Wall Street lost 90% of its value. At least it was thought of certainly by the bottom of the market, the dollar was exchangeable for gold at $20.67 to the ounce, which was fine. I mean, at least you had, your currency was fine. This time, the currency will take the strain. Boom, it'll go down to zero.
The awkward precedent of the 1930s is that the US arguably didn't exit recession until the Second World War.
Yeah, well, thanks to government intervention, it continued and continued. I mean, it started with Hoover, who of whom I don't know what's his name, the previous guy, Calvin Coolidge, said because Hoover was his business secretary. He said, "That man gives me all his advice, and none of it is good," or something to that. And I mean, he was an interventionist. He really was. And everything he touched, he screwed up. I mean, I've known people like that in business, and they've survived because they've got some sort of position. But I mean, they're complete idiots. And that was the situation. And guess what? He was replaced by another complete idiot with a New Deal, Roosevelt. Intervene the whole time, which basically meant that the economy didn't recover. If you looked at the previous slump, which was the post-First World War one, you had a slump between about 1921 and early 22. It lasted 15 months. It was deep, it was quick, and that was it. It was gone. The whole point being that governments, until Hoover came along, they knew that what they should do is they should just stand back, and there's a crisis in the economy, just stand back and let it all blow over. And that's what they used to do. And then along comes Hoover, followed by Roosevelt. And our problems really stem from them.
On the currency aspect, of course, when a currency goes down, it goes down against another currency. And I know you can look at gold as a currency. But which currencies...
Sorry, I must correct you. Gold is money, the rest is credit.
Right.
Currencies are credit.
Currencies are credit, right. So which credit from which countries do you think would fare I know you've mentioned Asia, but I'm thinking in terms of the dollar, the Swiss franc, the Japanese yen, which during a crisis, traditionally the dollar rallies, the Swiss franc rallies, the Japanese yen rallies. Would you be expecting this to happen again?
Well, I mean, you will get some volatility in currencies relative one to another. Of course you will. I think sterling is horribly overvalued. I can see that collapsing ahead of everything else, particularly when Rachel starts crying again. Really, I think the interesting thing is that China and Russia have gold. They've got lots of gold. I understand that in two wealth funds, Russia has a further 10,000 tons of gold, which could deploy, if you like, on the central bank's balance sheet. So they would have about 13,000 tons. That's Russia. I reckon that by 2002, the People's Bank of China had accumulated gold in the big bear market from 1983 onwards. When it was 1983 was when legislation was passed appointing the People's Bank of China to handle the nation's gold reserves. And between then and 2002, Chinese individuals were not allowed to buy gold. So they had a clear run at it. And they tucked this away, not on their own balance sheet as reserves, but they spread it around. My information is that it's gone into things like, for example, the People's Army account and also the Youth Communist Wing's account and so on. So it was all spread around. I reckon they could have accumulated a good 20,000 tons by 2002, which they then turned around and said, okay, we're going to set up the Shanghai Gold Exchange and individuals can now own gold. And they have been accumulating gold ever since. And if you look at the withdrawals from the Shanghai Gold Exchange, they total around about 27,000 tons since 2002. So China can go onto a gold standard, I think, quite quickly. The reason she hasn't is she knows that if she goes onto a gold standard, she will destabilize the global dollar-based fiat currency system. And that's not her style. She rather watches America make all the mistakes. I mean, it's Sun Tzu or whatever.
Never interrupt your enemy while he's making mistakes.
Absolutely, Tim. Yeah, that's absolutely right. So that's their view. They've got Russia in tow as a very close partner, running this huge, great circus, which at the moment is 70% of the world's population. This is where the future is. This really is where the future is. And I think that there will come a point when China and Russia will put their currencies onto gold standards to protect those currencies from the collapse in our currencies. So it's probably not all that far away now.
What would you say to the idea that the whole idea of gold being being money now is just a figment of people's psychology? Money is whatever people think money is, because they've been kind of programmed to think it. I mean, if you go back a long way, yes, of course it was. But if you go back even further, various other things have been used as money. So tally sticks and leaves and all those sorts of things.
Well, gold's easy to use in giant stone statues.
And actually stones as well. So what?
Cowrie shells. Look, it's a question of progress. I mean, it's a question of progress, and what becomes acceptable to the counterparties that you're dealing with. And also, when we set out colonies and dominions and all the rest of it around the world, I mean, you're dealing with all sorts of people, not just your local community. I mean, you could do it. I mean, you could do local community just purely on credit. I mean, there's a fascinating story, which is well documented, that in Guernsey, the States, which is the government in Guernsey, back in 1770-ish, something like that, decided they needed to build a new meat market, which now is still standing there. It's now actually, mainly the co-op and offices and so on. This was going to cost, I think the figure was something like £4,000. So what they did was they issued tickets which could be used as currency. And the tickets were, I think, £10 each or something. So they issued enough tickets to pay for the cost of the building. And out of the rent, they were able to redeem these tickets over the following 10 years. No money was involved. No money was involved. It was just done on credit. Classic example of how credit can be used positively.
And wasn't there something called the Brixton pound as well at some stage? I mean, there used to be a lot of currencies, and then, of course, the Bank of England became the sole issuer of currencies. The same in America, but there were little microcosms of money.
It works slightly differently. I mean, before 1800, London banks issued their own notes, their own banknotes. And I think by 1800, there was no London bank issuing notes. Country banks continued to issue notes, however, certainly into the middle of the following century. And the Bank Charter Act of 1844 basically handed the monopoly of note issue to the Bank of England. Country banks could still issue notes, but no new bank established could issue notes. So it was only the existing ones. And basically that sort of died out, particularly as clearing systems became a lot more efficient. So, but even to this day, the Scottish banks, which operate under Scottish law as opposed to the laws of England and Wales, they issue their own notes. So that still happens.
So people might not realize that when they have money deposited in a bank, they're actually lending that money to the bank. It's not like they hold it in a vault and then they'll give that money back at some stage and they make their money by lending it out. Well, of course they make money by lending it out, but they actually just create money out of thin air for whatever purpose they want.
Yeah, but I mean, that is ignorance, Paul. I mean, it is pure ignorance.
Yeah, but it's a system.
Basically, yeah, it's credit. You are a creditor of the bank, and if the bank goes under, you are a creditor.
Yeah.
Okay, we've got this sort of system whereby, the first 80-odd thousand, will be guaranteed by the government or some whatever, in the event that the bank falls over. But, it's credit. It's all credit.
Yeah.
And in that case, you've got a counterparty risk with the bank.
Exactly. So what steps do you think people should be considering then? I'm just actually also mindful that we've only got a few more minutes.
I've already said it. Get the hell out of credit.
Yeah, but I mean, okay.
You've got to have physical gold. And incidentally, if you have ETFs, then you're not possessing gold.
Right.
You merely have a piece of paper. In fact, you don't even have a piece of paper today. You have an electronic entry saying that you have a right, if you like, to an obligation from the company. But actually, you don't have it from the company. You have the obligation is to the central clearing system, like Euroclear, who actually holds that obligation on your behalf. So when it comes to you actually holding, you think you own, I bought some gold. What I've done is I've bought an ETF. Okay. The ETF might hold the gold. Okay. There are complications there because authorized participants, if you like, are not above shorting shares in the market, borrowing the shares to cover, delivering the shares to the ETF trustee, and demanding payment in underlying bullion. So, it's a pretty dirty story on that basis alone, apart from, the costs of running something like this. But when it comes to the ownership, the manager of the ETF has an obligation to deliver the underlying value of the ETF, not to you, but to Euroclear. Euroclear then has the obligation to deliver it to you. Now, why does this matter? In the sort of meltdown which we have been discussing so far, there's going to be massive counterparty failures and risks. Who bears that on the chin? Euroclear. Does Euroclear have any capital? No. How's it going to bear it on the chin? Well, it's going to take your stock, or what you think is your stock, and use it as collateral, basically, to try and save the whole system. Voila. Do you really want to be part of that? I think it's probably better to take the view, I would rather be safe than sorry. Get out of credit.
So when you say that was part of the question, when you were saying get out, you were just saying get out of credit. And what I was looking for was the next step is to get into. So I guess buying gold, obviously it's a bit more complex than just buying something that represents gold. What you're saying is you need to buy actual gold. And how would one do that? Or is this something for your Substack and your readers?
Well, basically, it depends who you are and where you are. Obviously, if you've got significant wealth and you decide, yes, this sounds like a sensible thing to do, then you're going to want to store it somewhere. You don't want to have it hanging around your home because nasty people come along and threaten to cut off your fingers until you tell them where it is. So you need to store it somewhere. And what you're looking for is storage through an agent which is not a bank, because banks are commanded to do things by the government, as happened back in 1933 in America with the executive order. Banks would take your gold, which you had given to them on a custodial basis, and submit it under government diktat to the Fed in return for gold at the new devalue rate of $35 an ounce. So you don't want to have it sitting with a bank as such. You want to have it secure. And the two ways in which you can do that, one is to go to an outfit like Gold Money, my old Gold Money, or if you've got significant funds, Von Greyer's AG, which is based in Switzerland. They've got their own private vault there. And always have it stored in a fully insured, proper vault. So that's if you've got lots. For a UK resident, UK national, you've got really a great opportunity because you can buy sovereigns with very little premium, and also Britannia's premium running at about 2.5%, 3%. And that is legal tender. And there is no VAT and there is no capital gains tax on it. So I think for the ordinary person, that's got to be the most sensible route.
And what about investing in real estate? Because obviously that will give you somewhere to live, maybe a rentable income, and it's not the sort of, it might go down in inverted commas value in a crash, but it's not going to disappear, and it has utility.
Well, I mean, you are right. You've got to live somewhere. You might even consider having a farm, which basically means that you can produce your own food and so on. But that takes a skill set which you need. I would refer you to the situation in Germany in their first big inflation, which was 1920 to 23. In the latter stages of that, you could have bought a 6-bedroom house in Berlin, in a decent part of Berlin too, for $100. $100 was slightly less than 5 ounces. So, because the exchange rate was 20.67. So that gives you an idea what actually happens to values in that sort of currency collapse. The other problem with property, of course, is that the maintenance costs rapidly exceed the value of the property. And the other problem with it is that if you look at leasing property, renting it out, whatever, rentals stay way behind the curve in terms of the collapse of the purchasing power of those rentals. Not a good option. I mean, you can wait until the collapse has happened, and as soon as you think, okay, it looks like the situation is going to be turned around, which is a judgment you have to make, then you'll be able to pick up all sorts of things very, very cheaply if you've got gold. But then you're getting out of gold and you're getting back into credit. That's the key. You don't want to hold, in the recovery, you don't want to hold gold because it's useless. It is absolutely useless. It's just a store of value. It just retains its value compared with credit. So when the situation eventually stabilizes, you want to get out of gold and back into credit.
One last question. Thoughts on silver?
Well, silver is fascinating because I did some analysis. For those who want to subscribe to my Substack, I did a bit of analysis on the relationship between gold and base metals, and sort of indexing them back to about 1900. You look at the value of a basket of base metals, and they are about 25% of that 1900 value measured in gold. Now, this is important. Okay, gold is maybe a bit ahead of the curve in these circumstances. One can understand that. But the basis of the suppression of base metal values has been the inflation of credit and the falling purchasing power of credit values not being reflected, if you like, in the value for these metals, for a basket of metals. So even measured in gold, the potential rise in base metals could be as much as 300 or 400%. And that is without considering gold rising. Now, so even if you regard silver as a base metal, without considering any of its monetary qualities, any of its monetary history, you can see it's wildly undervalued, particularly because of its really quite extraordinary properties. It's the photovoltaic cell industry is just booming. Defense, etc. Also, the sort of antiseptic qualities, the way it kills bug germs and all the rest of it. I mean, there's so many uses of it. It's the best electrical conductor, the whole thing. This is, I would say, it should be more valuable than even lithium. So on that basis, silver is very, very cheap. And we have the situation where people are beginning to realize that gold, they'll sort of think, well, gold is going up again. And when gold is going up again, how do we play this? I mean, can we really afford to buy gold, say, at $3,700 or whatever the day-to-day price is? It's probably easier to get into silver because silver's got left behind. So I think you'll see the gold-silver ratio fall quite rapidly, well below 80, well below 70, well below 60. I see it falling below 50. I don't want to put a timescale on it, but it does mean that you could be buying, when you switch back into gold, in effect, you're buying twice as much gold at the future price by leveraging it up through silver.
So, Alasdair, for people who want to get in contact with you, how do they do that?
Well, my Substack is, you can either go through my website, which is macleodfinance.com, or alternatively through the Substack handle, which is alasdairmacleod.substack.com. My rather, if you like, difficult for non-Scots spelling of my name might make Macleod Finance the easier way to access it.
Do you just want to spell it out just so people can...
Okay, well, Alasdair is Alasdair, Macleod, Macleod, .substack.com, or Macleod, same spelling, macleodfinance.com.
Fantastic. We'll put that in the show notes. And thank you so much for coming on the pod, and hope to see you soon.
Very much my pleasure. Thank you for having me.
Thanks, everybody. This podcast is for entertainment purposes only. Please do your own research or contact a professional advisor.